All right, it's 12:01, so we will get started. And just want to introduce this real quick. This is the Spartan Investments Fund 1 webinar. We are really excited to have Spartan as one of our preferred partners, and we're thankful for them and their support. And then we're also pretty excited about the opportunity to invest in this fund. I'm in several deals with Spartan already, and I am 100% investing in the fund. I already watched the other webinar. I'm excited for the questions and answer, and also to see this webinar, but I am investing. If you are interested in investing, make sure you fill out the Spartan commitment form that was sent on the last email. It will go out with the recording of this as well. That's so they know that you're a left fielder, and that way your investment will get aggregated with the rest of them. Last check, we were at 800 something thousand. So I think after this webinar, we will likely be able to get to the million to get us better returns. So that's fantastic. Before we get started, I do need to read one thing from the attorneys. And that is that this deal, this fund, has not been vetted by left field investors or any of the founders or members. Left field investors not recommending an investment in this or any other deal. We are presenting this opportunity only as a way for our community to invest and qualify for a higher return amount. The founders of left field investors may or may not invest in this deal, although, like I said, I am investing. But each person must evaluate this deal individually and must make their own investment decision. So I just had to say that. My apologies for the legal jargon, but we all have to protect ourselves these days. So with that, I would like to introduce Ryan Gibson. He is the CIO and co-founder of Spartan Investments. He's going to tell us everything we need to know about this fund. So thank you very much, Ryan, for being here. And thank you so much for being such a great partner to left field investors.
Yeah, you're welcome, Jim. And thanks for having me, and really honored and happy to give our webinar today. And I got your list of questions that was aggregated from the Left Field Investors group, and I really appreciate everybody sending in those very thoughtful questions and taking the time to read all offering documents, which I'll talk about on the webinar. And I also wanted to know that, or if you have any questions throughout the presentation, feel free to just put them in the chat box. And when we get to the end, we'll have plenty of time for Q&A. And we also have a lot of questions that are frequently asked questions that we'll go through as well. And I think we'll cover a lot of ground in the FAQs. Lastly, I'll just say, if you go to our website, spartan-investors.com, there is a fund Q&A document on there. So if you had wanted to go through and do some reading, there's a ton of stuff on there as well. So without further ado, I'll go ahead and share my screen here and we'll get started. Oh, Jim, can you give?
Yep, hold on. I'm on it. All right, that should be good.
Oh, no problem.
Does it work?
All right. Yep, looks like that did the trick. And we'll go ahead and get started. So my name is Ryan Gibson, Chief Investment Officer and CIO of Spartan Investment Group. And today we're talking about Spartan Storage Fund 1. This is the first fund that we've done at Spartan, and we're really excited to roll it out. But like Jim, I also have to give disclaimers. Lots of attorneys surrounding SEC stuff. We're not offering any legal advice or financial advice. Do your own due diligence on the offering. Consult with your own legal and tax team. We don't actually give any tax or legal advice. And this is just a general overview. So highly encourage you, if you haven't already, go through all the offering documents and make sure that you kind of look through all the details of the offering. So Spartan Storage Fund 1, what is it? So we're buying $400 million of new self-storage assets. In years past, we used to do it deal by deal. That was less efficient for our investors and less efficient for Spartan. Everybody was spending a lot more time, a lot more resources and effort. And the fund solves the issue of buying $400 million of self-storage this year in assets that we would have bought as individual syndications in the first place. That's going to encompass about 60 to 80 properties. And that's about $150 million total raise. So talking about the executive team, our Chief Executive Officer is Scott Lewis. He is the co-founder of Spartan Investment Group, And in the C-suite, my name is Ryan Gibson, Chief Investment Officer. And then the last person on the executive team is Ben Lapidus, our Chief Financial Officer. We have an office in Golden, Colorado, and in Seattle, Washington. So at Spartan, we're big on values. We're big on open and transparent communication. We're big on growing our team and our employees that join us both personally and professionally. That is our vision. And we have a mission to improve lives through real estate. And all of that can be summed up in our values. And our values are make the acronym GRIT. And that can be summed up with growth, respect, integrity, tenacity, and transparency. And investors can know that when they're investing with Spartan, they have the full weight of a best-in-class team behind them. Best in communications, best in due diligence in the industry. And we have a track record that really supports that claim. So this is a little bit about our track record and our team. We have about $200 million that we've raised over our lifetime since 2013. We've paid out over $10 million in investor returns. We have just over $500 million of self-storage assets under management in our portfolio. We have about 85 employees. I think that's jumped to about 100 employees. And this year we have plans to hire as many as 200 employees as we grow the portfolio and the need to support it. And for the last couple of years, we've actually made the Inc. 5000 magazine as the fastest growing private real estate company in the United States, the 5th fastest growing 1 year, and I think the 10th the year prior to that. And overall, 166th fastest growing company as ranked by Inc. magazine. That's our team at the headquarter level. But, first of all, if you've never done storage or never invested in storage, it's a great diversification strategy away from the stock market, from multifamily. It's a great thing to have in your portfolio. And the reason why Scott and I looked at this asset class as something that we wanted to do is because of this chart. Scott, his background as a military soldier and a veteran in Iraq Freedom. He in commanding troops. If he makes mistakes, people die. My background as an airline pilot, if I make mistakes, same things can happen. So we are very much risk. We like to mitigate risk. That is our focus. And if you look at self-storage over the last 4 downturns, self-storage occupancy has remained consistent, or it's even increased in some cases when GDP has fallen. So we really like the asset class. And if you think about kind of why self-storage is a good investment, if you think about what happened during COVID, storage relies on life events. Believe it or not, it's not something where people have too much stuff. That might be the case in some instances, but really it's because people have life events. They need to move, they need to downsize, they need to relocate. So when you have a disruption in the economy or in the market or in the world that triggers a lot of life events, you have a lot of self-storage activity. And you can see here, self-storage had during COVID outperformed all other REITs by a significant margin, really proving its darling status as a recession-resistant asset class. This is another interesting chart during COVID. During the January 2020 of May 2020, then the gold there, that was kind of when COVID first started. So you can see a lot of these REITs suffered a little bit when the speculative nature of COVID happened and what was going to happen and where we're going to go. Well, self-storage only went down about 9.4%, but then springboarded back up just as late as February 2022, up to 82%. Again, one of the best performing asset classes during the downturn and the disruption of COVID. So we started our own property management team to focus on storage. That's what we wanted to do. And we wanted to have our own in-house property management team that only focused on managing our assets. We didn't want to break the chain and go to a third party. We wanted to have our own property management group. So we started Free Up Storage. So this is our team at the corporate level on the Free Up side. And we focus on highly automating these properties. So we put in gate software, property technology. We make the facility automated so that we can reduce our payroll and our expenses and become more efficient. The other thing that we like about having our own property management company is we have Spartans on the ground in every single market that we're in. So we're on the ground in 9 states across the United States. And whenever we go into a new market, we put boots on the ground that are reporting to us directly as our W-2 employees. And this is just a little bit of an overview of all the places that we have facilities. We have about 54 properties across the United States. We're about the 30th largest operator of self-storage in the United States, owner and operator, under the Free Up Storage national brand. And you can see we have a high concentration in the southeastern United States. And we'll talk a little bit about how we've got the first few assets in the fund coming in Kentucky and North Carolina. We also do a lot of property improvements. So we have our own construction company that, again, is highly focused on self-storage and highly focused on just providing services for Spartan's investments. So just the team's experience amounts to 98 years of real estate construction experience. And this year we have about $36 million of improvements and in expansions already in the pipeline. And so really the most important thing is these builders are builders that know storage. We're not just hiring some random contractor in a market to build our property who's never built a self-storage. We're not hiring somebody we don't know. We want to mitigate risk. So we hire our own in-house team and they know self-storage inside and out. And the other thing the design that complements the customer and thereby complementing the investor. So our property management team knows exactly what improvements need to be made to make sure that the properties are operating to the standard of the Free Up Storage national brand. And lastly, we have a lot of tools to give us better reporting, better efficiency, deliver projects and on time and on budget, which is the most important thing. So getting back to the fund, why this fund? Why now? Why is Spartan going to a fund and getting away from the deal by deal nature of the transaction? Well, we really wanted our investors to be able to spread out risk. As a lot of investors can attest, in Spartan, they've invested in every single deal, and they want them to build they want to build a portfolio with that inside Spartan to mitigate risk by having a collection of properties and in a collection of markets, right? So by doing the fund, it allows you to participate in everything that we purchased this year versus having to kind of pick and choose and have all of your eggs in one basket on one property. So it really helps spread out risk, gets you better exposure. We have a lot of opportunities last year that people couldn't buy in because they already had their funds deployed or they had to miss this one or the timing didn't work out. You're going to get better exposure to better markets that we're in and also better facilities that we purchase. And lastly, potential for higher returns. And I really want to hammer on this a little bit. It's obviously a potential, it's a projection for better returns, but I want to just give a little anecdote. Right now, we have millions and millions of dollars sitting in bank accounts that are doing nothing. And that's because we have to allocate funds for each project individually and bifurcate using those funds across other projects. When we start a fund, we can use investors' money more efficiently because it can be spread across multiple projects, and we can start putting funds to work on cash flowing properties versus having to hold back construction reserves, hold back interest reserves, et cetera, property by property. It just makes your money more efficient inside of the fund. So what do we target? I mean, we can't just go out there and buy whatever we want. We go out and we specifically target properties that are over 40,000 square feet. We look for properties that may have expansion potential. They might not. And we also look for facilities that are kind of co-located in the regions that we're already in that will allow us to leverage our economies of scale. We buy a lot of metal, a lot of building supplies, and we cluster our properties together in the same markets, which helps us reduce our payroll and it helps us reduce our expenses in our improvements on the facilities. And then we buy underperforming facilities. A lot of mom and pop owners sell to us. They haven't raised rents in a really long time, and they have a full facility with a really long wait list. Those are kind of the perfect properties for us to purchase. Down the markets, we look in secondary and tertiary markets. You will not see us in downtown Chicago or LA or Las Vegas. We just target the secondary and tertiary markets. This is generally a market that's within 1 hour of a major metro. So for example, Jim is in a property in Tyler and Longview, Texas. That's about an hour to an hour and a half from the Dallas Fort Worth, right? That's what we call a tertiary market. Tertiary markets to some people mean like really, really, really out there markets. We stay far away from those, but we're usually within 1 to maybe 2 hours of one of the major metro airports like Dallas Fort Worth, like Chicago Airport, etc. But you won't find us downtown where all the heavy REIT competition is. We also look at markets where there's strong job growth, strong net positive migration of people. We want the trend to be in that market that people are moving there. And we want to see storage as a hyper local business. You know, some people say, oh, well, can you invest it? You know, what is it like investing in Houston for self-storage? Well, it depends. It depends on the sub-market within Houston. And what we do is we do a storage demand per capita for that specific area that project is in, because our customers are always within 3 to 5 miles of our facilities. So we look at the saturation benchmarked against the surrounding cities within that area to determine that specific property has excess demand or surplus demand. And then lastly, we look for, our second to the last thing, we look for rent growth opportunity. This is probably the most important metric that we look at. So we look at, can the rents increase? Can we raise our current existing customers up to market rent and have a significant value add potential there, sometimes as much as 20 or 30%. And lastly, we look at income growth. Obviously, the sign of a good economy or a good area is income growth, job growth, population growth, and that all equals rent growth opportunities. So just some of the things that we look at when we target a specific area. So you might think, okay, well, I participated in a few of your deals last year or in years past. What would be the most likely type of project that would land in the fund? What does right look like here? So I've got a few examples. So last year we bought Free Up Storage Cumberland. This would be the type of project that we would buy in the fund. This is a Class A facility. It's on a very busy street in Tyler, Texas. We have a lot of boots on the ground there. I believe we have about 9 or 10 facilities in that market. And this facility was a simple increase in collections play. And we would wrap this up in a larger portfolio to sell at some point to a REIT or an institutional buyer. And it produces 7 to 8% cash on cash the day we buy it. Very easy project, not a lot of value added to it. This is kind of represents the bottom of the risk curve when it comes to this fund. Now, this project is a project we bought about 3 years ago, Mini West Self Storage. This was a B vintage facility. It's about an hour south of Dallas, so really in that tertiary market of Corsicana. We increased collections about 40% in the 2 years that we first purchased it. And then we built an expansion onto that property, and it produced about 4 to 5% cash flow when we first bought it. And now it's producing about 12 to 15% annualized cash flow today due to the new units being added to the property. And lastly, the Boardwalk Portfolio. This was a portfolio that would fit right into the fund. These are the types of assets that we buy in the fund. We just can't go buy whatever we feel like, right? Has to be self-storage, has to be value add. And these are the specific criterion that we put inside of the fund. And I like to show a video. This is that Mini West property. Had a 9 or 10 existing buildings in place. And when we bought it, it had about 735 units total and 80,000 square feet approximately. And it came with some interior units like this one that you see here. And it came with some ancillary property like this car wash. Didn't really want the car wash, so we spun it off and sold it and made a profit, returned that money to our investors. And then it also came with ancillary income things like U-Haul truck rentals on site. But what we really liked is that it came with expansion potential. So you can see the 2 acres on the screen there. That was the opportunity to build those buildings that we built. And here's just a quick time-lapse camera that shows our construction crews out there building those additional units. We take it through the whole permitting process. We build these additional units, increase NOI, thereby increasing the property's value. And then we can cash flow more and the facility has more inherent value. So that's kind of an example project. So kind of switching gears. So how does your investment work? Okay, so you subscribe, you send your money in. How does your money get placed? And how does it get used inside the fund? So first of all, funds are accepted on a first come, first in basis, meaning that we will deploy your funds. If the first person who funded a couple of weeks ago, their funds will get deployed very number one. And then there's sort of a line of people that have placed funds into the fund that will get deployed on a first come, first in basis. Once we actually use the funds to buy a property, which is actually going to be in about 2 weeks, 100% of your capital gets deployed into the fund, and your 100% of your funds start accruing the preferred return. So that means that your pref starts to begin, and we deploy your funds into the portfolio into the Spartan Storage Fund 1, which goes across the portfolio of assets and activities that we have going on inside of the fund. And lastly, we project distributions to be about 1 quarter after your funds go active. So let's say you invested this month, our first property closings on June 2nd, your funds go to get deployed. You would expect your first distribution to be in the August or September timeframe from that asset. And we only are targeting assets that cash flow and hit that target 5% goal of year 1. So return structure. Normally, if you're not a left field investor, you would come in, Jim put together a great group here of people that invest together. So you guys all can analyze it, discuss it, but also get the benefit of how we give a bump in returns to people that bring $1 million or more, or collectively as a group. So as a limited member, this is for a $50,000 investment. The structure would be a 7% preferred return, and then a favorable 70-30 split with the investor until the investor achieves a 14% annualized rate of return. And then after that, it goes to a 50-50 split. So that is a Class A member, but a Class B member, which is the left field investors, that is an 8% preferred return, so a higher amount of cash flow. And this is the first profit goes to the investor before Spartan gets any profit from the operating returns or the liquidity event. And then it's still a favorable 70-30 split. And then that goes to a 16% annualized return before we split any remaining profits 50-50. So you get that bump in the preferred return by a percentage, and then you get a 2% bump in the hurdle in the more favorable 70-30 split for investments of $1 million or more. These are our target returns. We're targeting about 15 to 20% annualized returns, including the sale over the 5-year hold, 5 to 8% per annum cash flow along the way. So when you add the cash flow and the sales upside, that's how you get to that 15 to 20%. The 5 to 8% per annum, that's what you would expect on a per annum basis distributed monthly. And we do all of our distributions on a monthly basis. And we expect that cash flow to start about a quarter after your investment goes active. And that works out to about a 13 to 18% levered IRR. Never really seen a 13% IRR, but we just put a range in there just to be safe. Typically we're seeing in the high teens, sometimes even the 20s for IRR. And then our equity multiple 1.7 to 2.2x over the 4 to 6 year target hold period. So what's our exit strategy? We buy all these properties. We buy 80 self-storage facilities all across the United States, maybe probably in 4 to 6 states is what my guess would be, and the total amount of states. But what's our exit strategy? Well, we've made true to one thing at Spartan since we've started: optionality. We want to have options. We want to be in the best position possible to make the most return for our investors. That's why we rolled out the Free Up Storage national brand. That gives us an edge. That's why we have our own in-house construction team. That gives us an edge on being able to develop. But at the end of the day, we can do a variety of different things with our portfolio. We've already been approached by the top self-storage brokers in the United States. They want to break apart our portfolio and sell maybe the larger properties to a REIT, the smaller properties to more of a national operator, and they want to break it into multiple portfolio sales for a compressed cap rate. We can also exit the entire portfolio to a REIT. We can make one clean sale, and REITs are paying compressed cap rates for the ability to purchase a large transaction of self-storage. And I have a lot of data on that. Large portfolios are trading in the low 3 to 4% cap rate range, which is fantastic. And then lastly, we can do what we've done in the past. We can sell the properties off individually to 1031 buyers or local real estate investors that want to be in self-storage. So our growth plan: what do we do to these properties to make them really churn and really execute our business plan? Well, first of all, we perform initial improvements. Our customers are generally women. So I like to think of our customers as a 70-year-old woman. She's going to want to see a safe, clean, well-lit facility that she actually wants to go in and store their belongings. So when we buy these properties, there's a significant amount of fixing up to do sometimes, or sometimes the property is pretty clean, but that means cameras, drive aisles, paints, fence, lighting, roof, sometimes doors, sometimes repairs to the building, just to make the place elevated to our brand standards. So we perform initial improvements, and then that allows us, or sometimes even it's not even required, to increase collections, because we may be charging $50 and we increase those collections come into the property. And then we have the ability to expand the property. So we will buy existing properties that have expansion potential, and we'll do the expansion. And then big tenant sales
Hey, Brian, I don't know if you can hear me,
organization,
but
or tenant insurance
you're kind of
organization.
freezing up, Ryan, a little bit. Is he freezing for everybody or just me?
Yeah,
I lost him too, Jim.
Okay, thank you guys. Ryan, if you can hear me, you are frozen currently. Maybe he will log out and log back in. Just hold tight, everybody. Sorry about this. Just hold tight, everybody. I think he logged out, and we will get him back in momentarily. And then we'll go over all these questions. So if you have additional questions, please type them in the chat. If you are if you typed in any questions in the forum, if you're an infielder, we had a bunch of questions. He has a list of all of those, so you don't have to ask those. But if you have any other questions for him, I see Rebecca had one and Shay had one. So we'll hope that he gets back in here and he'll continue his presentation. So just hold tight, please.
Hey, Jim, do you want to answer? I don't know if you know, if they've entered their information through the soft commit button, the red button on the email. Do you know what next steps are once they've done that?
Yeah, so that's great, Ryan. Thank you for asking that. That doesn't do you anything as far as being that you're not soft committing really to them. You're just saying that if you put your money in and if you soft commit, you're going to be part of the left field investor group and the aggregation of your investment amount. The next step after that is to actually go to their link. And I think that was an email as well, for a soft commit. That's the actual soft commit. So because we're aggregating our investments, it's a little bit different than the normal. So there's technically two soft commits you have to do. One through that form where you're just saying I'm part of left field investors. And then you go and you commit whatever amount you want to commit. You officially commit that, and that's still a soft commit. So you don't have to invest at that point. You know, the hard commit is when you wire your money, and then you are in. It looks like Ryan is back.
Can you guys hear me okay?
Yeah, now we can hear you fine. Yeah.
Really sorry about that, guys. We actually just moved to a new office, and I'm sure the internet's just working its bugs out here.
No worries.
Yeah, so I left off at increase ancillary revenue streams. And I think this is probably one of my favorite things that we do in the portfolio, because we offer tenant insurance to our customers, and that is an added revenue stream with really no additional expense. So, you know, for example, we might buy a 300 unit facility, and in the first day that we buy the property, the current owner is not requiring tenant insurance. We require tenant insurance for all of our customers. We make it easy by offering them a provided vendor, and we get about 60% of that revenue. So we might charge $10 a unit on 300 units and collect $6 of that, and instantly we can increase profit by about $1,800 a month on a facility without any additional expense. So ancillary revenue is a big deal for what we do. All right. That's a really funny comment. You wouldn't see these type of glitches in the Right Field Investor Club. Very good, very good.
Thanks, Mike.
What about Centerville or Center Field? Okay, so Inaugural Investments. These are two properties that we have under contract. We're closing on these properties in the coming weeks. We actually have another webinar on May 18th where we're going to dive into these two assets that are going to be the seed assets for the fund. But I will say, high level, really nice properties built within the last couple of years. It's funny, I was just talking to our capital markets person who does all of our loans at Spartan, and they said, interesting conversation with the lender today. The lender who has the loan on these assets is gunning really hard to keep that loan because they don't want to lose these assets, because these are cash cows, cash flowing, and just really clean facilities that were built in recent time and in markets where there's a ton of growth and population continuing to come to the area. These are about two cities to the east of Louisville, and there's a lot of population and job growth in that market. And quite frankly, we're in one of the markets, I think Simpsonville, we're really the only competition in that market of significance. There's some smaller properties that aren't very as well maintained, but they're 100% full. So really like these properties. I like that they're cash flowing right away for the fund, because we really want to jumpstart the fund with great underlying cash flowing assets. But that kind of wraps up the webinar overview. And really, if you have any questions, you can sign up on our dashboard at Spartan-investors.com, and you can log into our investor dashboard. That's right there on the portal in the red circle there. And you can contact us at investors@Spartan-investors.com. Please just let us know if you are a left field investor so that we can log that in our system and count it towards the Class B share, so you get more return from the investment. So with
Ryan, can I just add on to that? I just said this while you were off real quick, but not only to log into their portal and sign up on the website, but make sure you fill out that form as Ryan Stieg said in the email I sent out. It's that big red button. That's the one that gets you into the left field investors aggregation, and then you'll get the higher returns, presuming we get to $1 million. So I don't know if you know this yet, Ryan, but do you know what number we're at for soft commits from left field investors?
So Lauren has been running point on that, and she told me 900,000 yesterday, but don't hold me to that. She just kind of said it in passing. So
okay, so
you guys are like right there. Yeah.
Yeah, it seems likely that we will get to the $1 million. But the first question Shay asked is if we commit and we don't get to the $1 million, are we committed? But I guess the answer is those are all soft commitments. So the only way you're really committed is once you send the wire. Is that correct, Ryan?
That's correct.
Okay, and we won't know for sure if we've gotten to the $1 million until everyone who soft commits actually sends the wire. So I would strongly recommend that if you want to invest in this fund, invest in this fund. And if we get to $1 million, that's just a bonus. I'm investing whether we get that extra, the extra benefits or not. And I would recommend that everyone look at it that way as well.
Yeah, good point. And I will say that your cash will be deployed right away. So there's part of the here. I can go back a slide. There's a note in the PPM that talks about how we can hold funds for 90 days, and then at 90 days we have to start accruing the preferred return for you, or send your funds back kind of at our discretion. But I'll tell you right now, our acquisitions team has $110 million in the pipeline. We already have properties closing on June 2nd. And then we have a property closing right behind that, just out of Raleigh, North Carolina. So I'm actually traveling out there today to go check it out and get it filmed for our marketing purposes. But we have a ton of properties coming in South Carolina, North Carolina, Kentucky, and Florida. So we have a big portfolio coming right behind it. And so funds will be utilized and deployed. So you start earning that return a little bit sooner. So that's great. All right. Couple of questions. FAQs. Do you have to be accredited? The answer is yes. Next question, it was, do we get the benefit of bonus depreciation? And the answer is yes, you will. You'll get a K1. It'll have losses on it, most likely in the first year. What tax documents do investors receive? You get a K1, and those all get delivered in March. So if you invest this year, we send our K1s in March of 2023 so that you can get to your tax returns on time.
And Ryan, just for clarification, sorry to interrupt,
sure.
but we get one K1, correct?
Correct. Yeah, which is one of the benefits of the fund is you're not going to have all these tax documents. You really just get one K1.
Perfect.
Yep. Distributions. I think I hit this pretty well in the webinar, but we anticipate distributions to begin 1 quarter after your investment is utilized. You know, our track record, sometimes we issue distributions much earlier than that. Sometimes we're a little bit later depending on refinances, but for the most part, a quarter is just an estimate. And again, I think we surprise people with earlier distributions more than we delay, but that's generally what we do. And then what is the anticipated cash flow? In year 1, we project about 5%. So if you put in 100 grand, you'd get about $5,000 distributed in the first year as a projection. And that would be broken up in 12 ways and distributed every month on the 1st. And we expect that to increase as high as 8%. You know, we've seen these self-storage facilities hit 10% cash on cash, and some, you know, start off at, 4 or 5%. So buying a lot of great assets, we're hoping to achieve that 8% cash flow. Distributions go out monthly. Do we do capital calls? The answer is no. There is no capital call requirements beyond your initial investment in the PPM or in the operating agreement. And we don't do capital calls for the fund. We don't call the money. When you subscribe, 100% of the money is called at the time of the investment. And can we invest with retirement accounts? Absolutely. EQRPs, solo 401ks, SDIRAs. We accept retirement accounts in all of them, all different types. And how long will we be raising money for this fund? Well, it's a first come, first in basis, like I explained, and the fund is open for 18 months or until it closes. So we've had a lot of interest in the fund. We actually have over 100 investors already placing capital into the fund. So we anticipate it closing probably, likely in 2 to 3 months is probably my guess, but really depends on kind of what we raise. I'm personally investing in this fund, and collectively as the principals, we're investing $500,000 to do the fund. So we are personally putting our money where our mouth is on this fund. And is there a redemption period? Redemption period generally means, can I lock my money up for a year and then get it back after some point? And the answer is no. This is an illiquid investment, and we're targeting the hold period to be 4 to 6 years for the investment opportunity. And can I increase my commitment through the fund? Absolutely. So if you do 50 grand and you have something that liquidates, later on this year, and you want to add another 50,000, you could just go into the dashboard and you can just fill out additional subscription agreements. It would still count towards that Class B share. But that fund, the funds that you have deployed early are, a different bucket of funds. And then the next funds that go in may or may not be deployed right away, depending on the need for those funds. So it's just based on availability later on. So I know, Jim, you had sent me a list of questions from the left field investors. And if you don't mind, I'm just going to kind of run through those right now. Should I just do that live? Is that a good idea? Uh-oh, did I lose you? Hopefully I didn't lose you.
Sorry, I was muted.
No worries.
Do you want to answer the ones in the chat first?
Sure.
I can. The
let's
first one.
Yeah.
From Rebecca is, when was the in-house property management team for Free Up Storage formed?
The day that we started the company. We've always done our own property management. Now the branding Free Up started at the end of 2020, but we've always done our own in-house property management. But from a branding perspective, the end of 2020, we saw the Simply Self Storage brand get formed and bought up by Blackstone, and we're like, we should probably be branding this in a consistent manner versus branding each property individually. So, but the property management company's been around for I guess 9 years.
Okay.
Yep.
And we answered this, the total amount of funds, or what's the total amount of funds that you've gotten so far, including LFI? So all in.
I think it's around 14 or 15 million.
Okay.
Yep.
And then one question that's not on here, but I was wondering about, how does it work with the, if we don't get to 1 million for the other the B shares right away, and we get there like in 6 months, then do all of our shares convert from A to B, or how does that work?
Yeah, we can take it on a case by case basis, but likely we would convert it.
Okay, perfect.
Yep.
And then let me see. When properties are sold, how are the distribution of funds characterized on the K1? Are they long-term capital gains, normal income, 1231 or 1250? Ooh,
Wow, that's very
tax question.
technical.
Yeah.
So before I answer this, I'm just going to say I'm not a CPA. Check with your CPA and do your own due diligence on this question. I have got experience trying to answer tax questions, and then it comes back to bite me. So I don't mean to sound like a walking disclaimer, but I do not give tax advice. My understanding is it's probably long-term capital gains, but it depends, because if we sell usually within 3 years, you got the carried interest rule when you're in partnerships. Sometimes that's capitalized as short-term capital gains. But I would check with your CPA. I don't like to give that exacting answer and be wrong, and then you tax plan and it's like, well, you said, Ryan, on that webinar that it was going to be this.
Right.
So I would just double check, but usually it's long-term capital gains because the properties are entered into service and they're considered rental property. And then we hold them usually for 4 to 6 years. So I would say that likely they'll be characterized as long-term capital gains.
Okay. And what about the state taxes?
Yeah. So our accountant seems to think, and again, same disclaimer as before, that it's really up to your CPA if they want to do a state filing. Typically they don't, but it's really up to your CPA if they want to do that or not. So we just do 1K1. It's a Wyoming LLC that is the fund. So you're just going to get 1K1 from us, and it's really up to your accountant to dig in and want to do one in every single state that we're in if it's required. So it really just depends on your accountant's preference.
Okay. And then if we invest now and decide to add additional funds in the future, will the funds receive the same pref of 8%? And I think that's a yes, assuming we get to the 8%, as long as when you put those additional funds in, you let them know you're with left field investors, then you'll get the same terms that we've qualified for.
Yeah, not right field investors though.
Yeah,
don't
exactly.
like those guys.
Yeah, well, that's just Mike.
I'm just joking.
Well, what's the difference between accredited or not? I can answer that. To be accredited, you have to have $1 million in assets outside of your home, or filing single, it's $200,000 of income in the last 2 years, or joint, it's $300,000 of income in the last 2 years. Plus, there's a few caveats. If you're licensed certain financial designations, you can be accredited as well. Okay, could you speak more to the debt terms? The OM stated target debt terms, but wasn't clear what had been locked in, especially around managing interest rate risk.
Yeah, interest rate risk is a topic of conversation every day. We've just actually locked up a 3% rate on a portfolio, the DFW portfolio. So we are, we get some pretty good preferential treatment from existing lending relationships, but we're underwriting everything in the fund at 5.25. That's super conservative for what we're getting in today's market. And what we're getting, we just, the latest term sheet that we locked up was 4.75%, but we've more than covered what the rising interest rate environment will handle. If that's your question. As far as leverage goes, we're targeting 60 to 65% leverage on these assets.
Excellent. And the next one, it looks like for me, I'm planning to invest using my self-directed IRA. If we get 1K1, how do I get one? Is the K1 modified after? Again, Ryan and I are not tax professionals, but you'll get a K1. And what my accountant does for my self-directed IRA is he says, please don't send the K1s because I might accidentally use them. He doesn't need the K1. So you'll get one, but you won't necessarily need to file it, I don't think. But again, ask your tax person. And then also for everybody, yes, left field investors, we're helping present this deal or giving you access to better terms. but everything goes right through Spartan. Any questions you have, go to Spartan, all the documents through Spartan. Left Field Investors is completely independent of this, so everything goes through Spartan.
Yeah. So if you want to reach out, you can reach out to Ed Osborne. We literally, that's what Ed's our VP of investments, and he handles all new investors and walks them through the process to make sure that they get everything answered and all documents on time. And then when you're an active investor with us already, you work with Ted. So you just add a T to that Ed. So you start with Ed and then you work with Ted after that. So we have two people, and Lauren Breichel as well, but we have two people that are dedicated to helping you onboard and have a smooth investment experience. So if you want to email Ed, it's ed@spartan-investors.com, or you can just hit us up on that investors email at the bottom of the screen there, investors@spartan-investors, and we can walk you through step by step exactly what you need to do to get subscribed and on the dashboard.
Excellent. And the webinar will be available for replay as soon as I can download it, edit it, and upload it again. So I'm hoping for today, more likely tomorrow. And then I think the other question from MSU was answered. And then Aaron, if we're an existing Spartan investor, do we just state we're with LFI on the portal when we invest? No, Aaron, make sure you fill out that form in the email I sent out. It's the red button. That's the best way to make sure that you are on the list as qualifying as left field investor.
And Aaron, when you subscribe, just check that Class B box on the subscription agreement when you're going through the process, and please let Jim know, because we want to just compare notes to make sure we didn't miss anybody. That's the big thing with Jim, letting Jim know. Yeah.
Perfect. All right. I think that is all for now on the chat. So if you have other questions, go forward with the chat. Ryan, do you have that list of questions we posted on the forum? Okay. If you just want to go through those.
Yeah. You want me to rattle through it?
Yeah.
Yeah. So, our marketing costs associated with the fund, not the properties, part of fees that are considered acceptable for expense reimbursement. No, when we go out and market the fund to people, we are not reimbursing those expenses for the fund. So, expenses for the fund are specific to the property level and the property closings. So the next question I have is, what do we plan on do to de-risk the rising interest rates that are occurring? We're underwriting these properties more aggressively with the rising interest rates in mind. We're also getting fixed rates on these assets, or we're getting a floor SOFR rate that's so low, it would take years and tons of rate hikes to get up to where fixed interest rates are today. We're just measuring that risk as we go property by property, but it is something that we are mitigating. And lastly, we have a lot of lending relationships. We're a $300 million borrower across probably 5 different banks. And so in fact, Chase is coming to our office in about 10 minutes to meet with us, talk about middle market lending. We're a middle market lender, partner with Bank OZK and Alliant Credit Union. So we have a lot of strategic relationships that get access to better rates than what you see in the market. So a lot of things going on there. We also have our own in-house capital markets team that goes and secures our debt. So we have somebody focused at Spartan just on that piece. That's all they do full time, every day in the office. What is the basis for the 6% property management fee? And they say the analyzer has 3 to 4%. We charge 6%. Okay, so here's the thing: in the industry of self-storage, Public Storage, Extra Space, CubeSmart, any third-party property management company that you hire in self-storage is going to charge you a 6% property management fee. They're also going to charge you additional fees for your call center, for doing marketing, like their job, basically going out and doing additional ads and Google AdWords and spend on Sparefoot and all these other things. We don't upcharge any of that stuff. So when we come in at 6%, we are way below what the market charges for third-party property management for self-storage, because we don't layer on all these additional costs. It's like buying an airplane and not including a pilot seat, right? A lot of these property management companies do that. They'll say, oh yeah, it's 6%. Oh, you want a call center? Well, of course we want a call center. They'll add on costs, add on costs, add on costs. So we don't add in those costs and layer on our property management fees. So we're actually probably one of the more efficient property management fees in the industry. So 6% is very normal for storage. And you can call another provider and fact check me on that, and you'll find that 6% is pretty normal. Why does the cash on cash return drop so dramatically in year 2 and rise dramatically in year 2? 4.2, 2.9, 4.5. I'm not sure what that's in reference to. So I apologize. I'm not really sure what that's in reference to, but we're projecting cash flow of 5% in the first year, and then increases thereafter throughout the fund. Now, every business plan, every property might have its variations in cash flow. For example, we might buy a property like Cumberland. It may cash flow 8% day one, right? We may buy the Louisville properties, which are projected to cash flow 5% day one. So the blend, you'll get the blend. But another property might come in and have an expansion potential that causes the cash flow only 2%. But then once it's leased up, that'll start increasing because you have those additional units. It's going to be a blend of business plans. And our target is to make sure that the blend is at least 5% in the first year, increasing every year thereafter. So if you're looking at an underwriting file for a specific property, which we put on the dashboard, it may fluctuate depending on that property's specific business plan. But we're always keeping in mind keeping the cash flow consistent in the fund. Okay, I'm trying to get through some of the easier ones and then dive in if we have time on the harder ones. Development fee. The exhibit has a developer fee up to 10% of construction costs. However, the example provided in the PPM, page 25, the developer fee is shown as calculated on the initial improvements and construction costs and the total acquisition costs. This fee charges in 13%. My calculation could be mistaken. Yeah, so let me just provide clarity. So whenever Spartan buys a project, we have to keep the lights on here and hire our team and our staff to operate it. So we charge what's called an acquisition fee, 2.85%. That's pretty standard in syndications to have an acquisition fee. That's based on total project cost. So if we have a property that we're buying that's $10 million and $1 million to fix it up and repair, we'll charge 2.85% of $11 million. That's our acquisition fee for acquiring the assets in the fund. The other thing that we charge is a developer fee. So this is only if the property has a development component to it. For example, we had a property that was in 4 years of entitlement and permitting, where we had to move wetlands, get easements, setbacks, restrictions, and do all these things, right? And so we had to pay a team and time to handle that development. So we'll charge a developer fee for that. And that's up to 10% of only the costs that we spend on those permits. So in that particular case, we spent $1 million in permitting fees. I know it's kind of crazy, but it was worthwhile project. So that would be up to $100,000 fee for taking it through those permits and entitlements. And we have to staff people out of that process. And so that's how we pay them. The last fee that we'll charge is a contractor fee. So because we have our own contracting company, we will pay them for services rendered of up to 10%. If it's a smaller job, it's going to be closer to 10%. If it's a huge job, it'll be closer to 5 or 6% of only the construction costs bared to build that project. And this is only in lieu of not having a third party. So if we went out there and we wanted to build a self-storage facility, we'd have to hire a contractor and we'd have to pay them a similar fee. But we wouldn't double charge that fee. It would only be if we used somebody in lieu of Spartan. Okay, so how many states will their facilities be located in and which states? I'm predicting North and South Carolina, Kentucky, Florida, Georgia, Tennessee, and Texas. That's my rough 6-state WAG on where we think the assets are going to be located. That's basically where we buy today. There might be a smattering in there from other states like Wisconsin, but for the most part, you can pretty much anticipate the southeastern United States where a lot of the population is growing, and then Texas where we have a massive footprint currently. Okay, so last question, I believe. How would sales of current Spartan investments work rolling into the fund? So we are double appraising properties. So 2 appraisals. One, we're hiring Newmark, Chris Sorrento, who's the #1 self-storage appraiser in the industry, to independently evaluate rolling properties into the fund. And secondly, the bank is going to have their own internal appraisal. They can't rely on an appraisal that we provide. They have to charter it and execute their own appraisal. So that's two appraisals that we're going to have to value the assets that would potentially, that we currently own, that we would sell into the fund. So why do that? That doesn't make any sense. Or, you might be thinking, hey, why would you, there's no value left to add to these assets. Well, it's technically, there's a ton of value still in some of the assets that we have. Specifically, there might be an expansion or ground up potential. But what it does is it allows us the opportunity to recapitalize those investments with lower interest rates with a credit facility. So we're currently working on a $500 million credit facility that would be a very low interest rate, 2.5–3% interest rate. And by rolling assets into the fund and doing that arm's length transaction where we would buy the facilities, buy the fund, that would allow us to better service the debt on those assets and increase cash flow. Even though we may have squeezed a lot of value out of those properties, there's still collections potential through rental increases. And REITs are predicting, the REIT reports, we read a lot of the REIT data, they're projecting about 9 to 13%, depending on markets, rental rate increases just in 2022, which we've started to see play out. So still a lot of value to add to those facilities, and it helps us better recapitalize them. It also gives our investors that are in current single asset syndications a liquidity option. If they want to cash out, they can. If they want to roll into the new fund, they can. So just a lot of different ways to kind of work through those existing investments.
And Ryan, just to on that, is Spartan charging disposition and acquisition fees on their own assets?
No. So the way that this works, and I'm really glad you asked that. So not only that, but we're also not charging the full amount of acquisition fee. Development fees are for the facilities that go into the fund. So let's just say we have an asset that we paid $6 million for, and the fund buys it for $10 million, just making up a number there. We would only charge the $4 million difference. We wouldn't charge it on the full $10 million because we've already feed it, right? We're not going to double fee it. That's
Okay.
just against our values. Yeah.
We have another question in the chat. What % of depreciation is allocated to Class B members, assuming LFI hits that mark? And if
Sure.
not, what % goes to A? The PPM shows Class C as 50% of the depreciation allocated. Also, what % of capital should we accept toward depreciation for Class B? So can you talk about depreciation and how it's split up for the shares?
So we've already had our CPA go through this. You can expect about 25 to 30% of your investment will have depreciation. So it's about 15.
Can you say that again?
About 25 to 30% of your investment that'll be the depreciable amount.
Okay.
Just to kind of keep it simple. I mean, I would say if you invest 50 grand, you could expect at least $15,000 of depreciation. Assuming we buy these properties and they go into the fund and everything kind of shakes out, but we do a full-blown cost segregation study, and then we do 100% bonus depreciation.
Okay. And I know you have to run right at 1.
No, you're
There's
good.
there's a couple more questions here. Are you cool if I read them out?
Yeah, I've got time.
Okay. So what are Class C shares? How much do they cost? And how many do the GPs get?
Yeah, so great question. The Class C shares are Spartan shares. So we are allocated those shares right away for putting together the project, putting together the fund. And then what we basically do is we sell Class A and B shares depending on what sells. So for example, I believe it's 2,000 shares of Class C and 2,000 of Class B, but let me just do some quick math in public here. So you take 2 million, if you take $200 million, which is the maximum we can raise for this fund, and you divide that by 50,000, I'm sorry, that's 4,000 shares. 4,000 shares are allocated to passive investors. 4,000 shares are allocated to the Class C investor shares. Does that answer your question?
Yeah. And so when you said at the beginning that you guys are investing up to $500,000, is that an A or B or C?
An A. So
Okay.
we invest with our investors. We don't want to be,
Perfect.
yeah, we're investing alongside you. It's like we're cooking up the meal, and then we're going to sit down at the table and eat it with you. So,
Awesome.
Yeah.
All right. We're going to get into the weeds here for the last 2 questions.
sure.
And I know that you memorize the PPM word for word, page for page. So here we go. Page 7 of the PPM says, quote, sponsor through their membership interest in Class C units shall be allocated 50% of any applicable depreciation expense. Does this mean they get depreciation on any profits and the write-off on their tax at 50%? How does this impact our K1? I think you already answered that.
Yeah, so we share the depreciation. So we will have at risk, what the IRS considers at risk investment. So we are guaranteeing these loans, and the IRS allows for the general partner, Spartan Investment Group, to take depreciation because of that. We've also got our own personal capital, but that's going to be on the limited member side, so it doesn't really matter. But Spartan will get depreciation and share that with its investors. Okay,
moving on to page 19, middle of the page, quote, the fund's business will not be diversified. So their question is, what is the acronym capital ACM? It seems to appear out of nowhere.
I will check on that. I do not know
Okay.
that answer, but
All
that's
right.
a great question. I know that PPM inside and out, but that is a good question. I'm not even going to try to guess it incorrectly. I'm going to make sure I get the right answer, and I'll get
All
back
right.
to you
Well,
guys.
we'll get back
Yeah.
to everybody on that one. And, you know, I'm giggling about the people asking questions on the PPM, but I think it's fantastic. Those
Yeah.
that read it, that's what you should be doing. So thank you for that. But it still does make me chuckle a little bit because we're so deep in the weeds. And there's one more, PPM page 34. Member may be allocated income from the fund, although he has not received a cash distribution of such income. How is that possible? And will we owe taxes even though we receive no cash distribution?
Yeah, so I believe what that speaks to is it's kind of interesting. I'm going to totally nerd out on this. And by the way, I love the fact that you guys read the PPM. I actually put on an entire webinar on how to read a PPM and how to dive into it. So I really appreciate you guys reading it. I read it with my team probably 10 times before this deal goes live to make sure that they're all on the same page and they know every single word in it. Not every single word, but you know the generalities of it. But basically what that typically means is, so the IRS looks at the security different than the SEC looks at it, or from the purposes of like the waterfall. So for example, we get a preferred return. So you guys are going to get, so the tax return is going to come in and they're going to say, well, Spartan made money and we may have not made any money because we may be giving you guys the preferred return. But the IRS may not look at it that way. They may look at it differently, where they account 50% of what's been distributed as our income. So we might get income that we never got taxed, right? So we may be taxed on income that we never actually received. That's the simplest way I can answer that question. I think if I keep going, I'll probably just confuse people. But that's what I believe that means. There might be income to the partnership that you actually never got, but it's just the way that it's been allocated in the waterfall.
Okay, that makes sense. So I'm going to pause here for a few seconds. If there are any other questions, you can unmute and ask in that fashion, or you can throw it in the chat. But while we're kind of waiting for those 30 seconds, Ryan, I want to thank you for this webinar. It was fantastic. I want to thank you for the partnership, and to anyone who is thinking about investing, again, you know, no pressure from us. Invest if you feel it's a good deal. Everyone, you know, do your due diligence, ask questions, post things in the forum, and we'll figure this out. If you are sure you're going to invest, make sure you fill out the LFI investor form. That's on the email. I'll send that out again. Plus, do the commitment through Spartan's website. And, you know, a lot of times I like to hold my money until the last minute and send it in so I can collect that 0.1% interest that the bank pays me. But in this one, I'm going to fund it next week because I want to get this rolling so we can get to our million so that we know we're there and locked in. And so I would encourage you, if you know you're going to invest and you have the capital, go ahead and wire that in so that we can start building our soft commits into actual wired in money. That would be helpful. And I see that there have not been any new questions in the chat. So Ryan, thank you very much. If you have anything else to say, now is the time. Otherwise, we will close this out and I will send it out as soon as I can.
Great. No, I've got nothing else. I just want to thank everybody for watching, and reach out to our team if you have any questions.
Perfect. Then we will end it here. Thank you so much, everybody, for joining. This is great attendance, and we'll see you next time in the left field.
All right, great. Thanks.
Thank you all.
All right, later.
Bye.